Today, we are deconstructing one of the most fascinating and, let's be honest, controversial financial strategies out there. MicroStrategy's ambitious plan to not just own Bitcoin, but to actually beat it. And that brings us to the big question, right? It sounds kind of impossible. I mean, if a company's main asset is Bitcoin, how in the world can its stock deliver a better return than Bitcoin itself? Well, that's the puzzle we're going to solve today. The answer, if you ask the people behind this, is that you have to stop thinking of MicroStrategy as just a software company that happens to own a lot of crypto. You have to see it as what they call a purpose-built financial machine, engineered for one single goal. So let's pop the hood and see how this thing is supposed to work. Okay, so what's the big idea here? Well, the entire thesis boils down to one powerful concept. This is not about passively holding an asset. It's about actively using the company's structure to create leverage and, this is the key, to grow the amount of Bitcoin owned per share over time. And that is the crucial difference. A Bitcoin ETF, it just mirrors the price. MicroStrategy's goal is to accumulate. The whole point is for your one share of the company to represent a bigger and bigger slice of the Bitcoin pie as time goes on.
All right, so how do you even build a machine like this? Well, the foundation, the very chassis of this whole operation is the company's balance sheet, and it has been intentionally designed for a very specific purpose. If you look at a typical company's balance sheet, it's a mix of all sorts of things, right? Different assets, different kinds of debt. It's complex. MicroStrategy's is, well, it's radically different. On the asset side, it's just a mountain of Bitcoin. But the liability side is what's really interesting. It's not risky short-term debt. It's almost all long-term capital with fixed, predictable costs.
This brings us to the engine of the machine, something called structural leverage. Now, this is not the scary kind of leverage you might be thinking of, the kind that gets you liquidated. This is about using long-term debt, where you know exactly what it's going to cost you, to buy an asset with completely uncapped potential.
And this is the absolute game changer. Because the debt is structured this way, there are no margin calls. If Bitcoin's price crashes 50% tomorrow, nobody is forcing them to sell. This completely flips the script. Bitcoin's famous volatility goes from being a massive threat to being a strategic opportunity.
Okay, so the machine is built to handle the bumps in the road, but what about the gas? Where does the fuel come from to keep buying more Bitcoin? Let's look at the capital engine. They have a few different tools in the toolbox here. They use things like convertible bonds, which are basically loans that can turn into stock later. They use preferred equity, where investors get a fixed payout. And they can do what are called at-the-market offerings to sell new shares. Think of them as 3 different pipes to get fuel into the engine. But look, no matter which tool they use, the game plan is always the same. They raise money at a fixed, predictable cost. And then they turn around and use that money to buy an asset with totally unpredictable and theoretically unlimited upside. It's a long-term bet that the asset's growth is going to blow past the cost of the capital.
Now let's put it all together. This is where we see how all these parts are designed to work in a cycle, to create what supporters call a self-reinforcing flywheel, a system that just keeps growing the company's Bitcoin stashed on its own.
Here's how it's supposed to spin. Step 1, the market gets volatile, and for various reasons, the company's stock starts trading at a premium to the actual Bitcoin it holds. Step 2, they seize that moment and raise more money by issuing new shares at that premium. Step 3, 100% of that new cash is immediately used to buy more Bitcoin. Now, step 4 is the magic part. It's called accretion. If they do it right, every single share, both the old ones and the new ones, now represents more Bitcoin than it did before. And finally, step 5. Investors see this happening, demand for the stock goes up, which reinforces the premium, and the flywheel is primed to spin all over again.
And the really bold claim here is that this isn't just a strategy for a bull market, because the engine is volatility itself, not just rising prices. The idea is that this flywheel can spin no matter what the market is doing, up, down, or sideways, constantly turning all that chaos into more ownership for shareholders.
But wait a minute, I know what you're probably thinking. They keep issuing new shares. Isn't that dilution? Isn't that bad for the people who already own the stock? That is the #1 criticism, so let's tackle that head on.
You hear it all the time. The share count is going up, so your slice of the pie is getting smaller. And on the surface, that makes perfect sense. But supporters of this strategy will tell you that those critics are just measuring the wrong thing.
The whole counterargument is about shifting your focus. Yes, of course the number of shares is going up. But if the machine is working, the amount of Bitcoin that each individual share lays claim to is also going up. The goal isn't a low share count. The goal is to make each share more valuable in terms of the actual asset it represents. Let's make this super concrete. Look at this simple example. Before they raise money, let's say the company has 100,000 Bitcoin and 10 million shares. Simple math, each share represents 0.01 Bitcoin. Then they issue 500,000 new shares and use that money to buy another 1,000 Bitcoin. So now, yeah, they have more shares outstanding, but look at the bottom line. The Bitcoin per share actually went up. Every single share is now backed by more Bitcoin.
See what happened there? That's what's called an accretive issuance. So from this point of view, issuing new shares isn't a bug that hurts shareholders. It's the central feature of the machine that's designed to grow their ownership. It's the whole point.
So let's pull it all together. We have this specially designed balance sheet, we have the structural leverage with no margin calls, and we have this accretive flywheel. Let's look at how this all adds up to the final equation for outperformance.
And proponents will point you right to the historical data. This chart, based on the source material, shows that since this whole strategy kicked off back in August 2020, MicroStrategy stock has returned almost double what Bitcoin itself has, even after going through some pretty brutal bear markets.
In this whole process, the sum of all these parts has a name: shareholder amplification. It's the big idea that when you combine the special leverage with these accretive capital raises, you can create a compounding effect that allows the stock to actually outperform the asset it holds.
So let's just boil this all down. 4 key takeaways. 1. This is a way to get leveraged exposure to Bitcoin without that dreaded margin call risk. 2. It's designed to literally turn market volatility from a risk into an advantage. 3. The single most important metric to watch isn't the stock price, it's the growth of Bitcoin per share. And 4, the whole shebang is designed to amplify Bitcoin's returns.
Which, of course, leaves us with the big question. Is this a truly sustainable financial machine that can keep outperforming for years and years? Or is it just a really complex bet that relies on a never-ending cycle of market volatility and investor demand to keep the whole thing running? That is the multi-billion-dollar question at the very heart of this strategy.